Uh, so we're going to turn to California, and as we've discussed thus far, it is still all about the pandemic. So the image that I want to start with, of course, is there's me in my designer mask, California designer mask for the occasion, and the iconic Pink's chili dogs. It was closed up, and they've now just announced that it is going to be opening up. And that's kind of the image, it's that opening that really affects our forecast. So our roadmap for today is to begin to talk about employment. Where are we in California? What are the sectors that are hurting? And then to turn from that and look at individual sectors, some that are going to foster growth in the recovery and others that are going to be drags on the economy. And then I want to do a little bit of analysis, or show you some analysis on this narrative that everyone is leaving California, the mass exodus. And the discussion thus far has been focused particularly around the Bay Area, relating to the dramatic fall in rents in the Bay Area. So let's look at some data and try and understand what that's all about, and that will lead us to the forecast. So let's begin with employment. And what you see here is non-farm payroll employment in California, and it goes back to 2005. You see the dip there in the Great Recession, and then fairly dramatic, higher than US growth rates in non-farm employment, going all the way up to the close up in March due to the pandemic, a big drop, not as much as the depth of the Great Recession, but still the recovery has been good, but not great. We're still 1.4 million jobs shy of our previous peak, and that doesn't count trend. And when we break that down by sector, so this is December 2019 to December 2020. We don't have any payroll job numbers for 2021 because those are usually postponed till later in March when a benchmark revision is done. But this is through December of last year, and it's certainly illustrative. And you see that there are really four big sectors, the ones that are here on the right, that are highlighted in red. The other sectors have some job loss, but not very much. Those four big sectors are leisure and hospitality, education, both public and private, and that's because the schools are closed. Other services, which is where salons and barbershops and spas and the like are, and retail, brick and mortar retail, of course, as you know, was in trouble before the recession. Those are all sectors that involve people getting together and having human contact. So this is really all about the pandemic. These are the sectors that are hurting and the sectors that are going to recover more slowly. Those four sectors amount to more than 3/4 of all job loss in California. That's really where the action is. So let's look at individual sectors. In leisure and hospitality is tourism. California hosts about 1/4 of all international tourists who come to the United States. And the two major ports of entry where they come directly to California are LAX and SFO. LAX is on the top, SFO on the bottom. This is passenger arrivals. It collapsed in March and is still low. And because individuals who live in other countries who are thinking about a US vacation only know what they know about the US, and it's dealing with the pandemic, which is actually not good news, right? Are going to be reticent to come to the US. And so we expect this aspect of leisure and hospitality to recover very slowly in California. That'll be mitigated somewhat by the fact that Americans don't know a lot about what's happening in other countries, and California is a good tourist destination. So we expect more domestic tourism, and the domestic tourism part to recover with some rapidity. But our expectation is, because international tourism is so important, particularly in places like San Francisco and Santa Ana, that it will only partially mitigate, but not entirely. So that's a sector that's going to be a drag on the economy. But government, which usually is a sector that's a drag on the economy in a recession, will not be. What you see in this graph is cumulative general fund revenues by fiscal year. It starts in July, and then as you move from left to right, it accumulates through the year. The blue line is the fiscal year 2018-2019. The red line is the next fiscal year, 2019 to 2020. And you notice that that's pretty much above the previous year. And that's what we expect year to year. But that's where the pandemic starts. And it ends up the year in the last month in June for tax revenues to be a little bit below what they were in the previous year. But importantly, that gray line there through January is above both of those. Those tax revenues, the general fund revenues in California, are higher than they have been in the last 2 years. That's reflective of the fact that the tech industry really has not been hit hard. In fact, has prospered in general, some companies not obviously, but has prospered in general in this pandemic. And that generates income, particularly amongst the highest income earners in California, and general fund revenues. The important thing here is, you remember the second block there, the second red block was education. This means with Prop 95 funds that the funding will be there to reopen schools when the public health crisis abates and schools reopen. Turning to some other sectors, this is California home sales, single family homes. These are existing homes. And what you see is January 2004 to January 2021. This is California Association of Realtors data. And home sales today, although in January it was a little less than December, they are higher than they have been at any time since prior to the Great Recession, since way back when we were having the housing boom, with the exception of that one little peak there. That one peak represents financial institutions blowing out a lot of foreclosures. So home sales are good. Home prices are up double digits in California, all around the state. Higher home prices, robust home sales means that developers are able to make business plans that hunt and begin building. And so we have an increase in residential permits and construction as one of the growth sectors. Now there's some capacity constraints as well as regulatory constraints to faster growth in residential construction. But nevertheless, we have pretty solid increases in construction. And from 2020 to the end of our forecast, there's a 30% increase in home building. Turning now to logistics, we know that the logistics sector has been prospering because of the shift to online purchases of goods, but also there's this potential drag that back a year ago, 2 years ago, was because of the trade war with China. That seems to be over with. What you see in this graph is the year-over-year change in goods movement through California ports. All that red that's kind of clustered together is the trade war. The trade war is still on, but supply chains haven't changed a lot. And so the blue there is the year-over-year growth in goods movement through California's 4 largest ports. That supports our logistics. And if you've gone out through Queens Gate or Angels Gate on a boat over to Catalina anytime recently, you will see ships just lined up waiting to unload. So logistics is going to be a strong sector. And now, having looked at sectors, let's look at this question of, is everyone leaving California, and some evidence from the Bay Area. To do that, we want to look back at times when people really were leaving California and see what it looked like then. And in the early 1990s, those of you who were here in Los Angeles remember this with the aerospace contraction. Rents fell by 14.3%, home prices by 3.5%, and employment by 3.5%. And people were leaving. In 2001, for those of you in the Bay Area, you remember this was a particularly severe contraction in tech, and Bay Area rents fell by 25%, home prices by 2.4%, and employment by 7.5%. But interestingly, if you take out those sectors that are the 4 sectors I showed you in red, the non-tech sectors, employment fell by 10.1% in the Bay Area. So what about today? In the 2020 pandemic recession, in the Bay Area, rents fell by 13%. That's a big decline in rents, but it's smaller than the other two. Home prices didn't decline, they went up. They went up by 2.9%. And year over year prices, for example, in San Francisco, are up by over 9%. Employment fell by 8.8%, but if you take out those same four sectors, employment in tech tech and other sectors is only down by 2.5% in the Bay Area. So if you remember the test that we used to take, one of these is not like the others. It's clear which one it is. Doesn't take too much thought on that. And that is because the pandemic is really different from these other contractions. It's not a contraction in a sector, it's a public health crisis. And we haven't seen this really since 1918, 1919 influenza pandemic. So let's take a look at some data. One question that we asked, and the first question was, well, there are low interest rates. Was this a shift to home buying? And let's look at the left-hand chart. And in the left-hand chart, what you see is a bunch of dots. Each one represents one of 31 cities in the Bay Area. Across the horizontal axis is the change in rents, and on the vertical is the change in the Z estimate, that's the Zillow estimate of average home prices. And you look at these dots and there doesn't seem to be much in the way of correlation. In fact, there's no statistical significance to that. There are two red dots there. One is San Francisco and the other is Milpitas. Those are our outliers. And the San Francisco has a decline in home prices, but other measures of home prices for San Francisco show an increase. And certainly there's a large increase year over year. So that might, in the Zillow estimates, just be a correction. The other is Milpitas, which is kind of a suburb of Silicon Valley, and both rents and home prices went up. If we take those two outliers out, you get the chart on the right. And now we get a bit of a negative correlation, but it is also not significant. What this says is that though interest rates are low and people may be shifting from renting to buying, they're not doing it within the same city, but they may be moving out to outlying suburbs, moving from San Francisco to Dublin or Antioch or someplace. This only says that within the city, that's not happening. So let's look at some other evidence of factors that might explain this decline in rents while home prices go up. One is that in the Bay Area, there are 300,000 college and university students, and there's junior faculty associated with them, all of whom are renters. Now, some of those are commuters, some are in dormitories, but that represents at least some segment of the renting demand or rental demand, and they're not on campus, so they're not demanding apartments. So that's going to be a factor, we think. Tech workers leaving, well, these would be the low-income tech workers because they're renters, not homeowners. And as well, in places like San Francisco, there are folks who have homes out in, say, Napa, but they work in the city, so they have a pied-à-terre where they can rest their head during the week. So we want to look at these tech workers leaving. Might be overshooting their rents pre-pandemic. It might be low-income workers such as restaurant workers who can no longer afford their apartments, doubling up or moving out. Or it could be, if none of these really explain much, it could be the end of Silicon Valley due to high housing costs. So let's take a look at the data. We estimated a model and we estimated a number of models, looked at a number of alternatives, as many as we could. And what we found was the top two explain 80% of the decline in rents. It's students and junior faculty not on campus, and low-income tech workers avoiding having to pay the high rents to be close to Silicon Valley or San Francisco, and moving out to lower rent areas. And you can see that in this graph. This is again, it's one bedroom apartment rents. Along the horizontal is the actual change in rents, same 31 cities. And the vertical is what the model predicts. And you can see it's all clustered around that 45-degree line. The model is actually a pretty good model. And the two that are a little bit separated, those are our two outliers of Milpitas and San Francisco. So where did they go? This is not our analysis. This comes from the San Francisco Chronicle. It's an analysis of change of residents with the United States Post Office. So it's filing that there's a new address. And you see here that of those in San Francisco who changed their residence, 84,728 changed within the Bay Area. So that suggests just moving out to less expensive parts of the Bay Area, but not leaving. 24,000 elsewhere in California. Most of that is in Los Angeles, and you'll see momentarily why that might be. Outside of the state, leaving the state, the largest is to the state of Washington, 1,227. And that, as we know, is another big tech hub. And that's sort of normal. And the rest are really small. So that suggests that, that there's not this mass movement. And another way to look at this is to follow the money. Is tech actually leaving with people? This is new venture capital investment in the second half of 2020, according to the PricewaterhouseCoopers money tree, which tracks this. And in the Bay Area, it's $25 billion of new investment, and that's a growth in investment. And that's 2.4 times the next two, which are more or less tied, New York and Southern California, both tech centers. And then comes New England, then the Southeast, which is Atlanta and Miami, much smaller, and then Texas is over on the right, smaller still. So there's really no evidence in the data that we have tech leaving California or people leaving California. It is still all about the pandemic. There's no mass exodus from California. Job loss remains in these human contact sectors, partly due to the public health restrictions, but also COVID risk aversion by consumers. Tech, logistics, and housing show strength and will lead us in the recovery, particularly when the pandemic is in the rearview mirror. And California state government revenues continue to grow. So that is also a source of strength. That leads to our forecast. We have strong employment growth this year, 5.6%, followed by 3.1 and 2.2% in the coming 2 years, driving down the unemployment rate on average in 2023 to 4.1%. And pretty good growth in housing, not enough to make a change in affordability, but still pretty good growth in housing, making construction a sector for employment growth. So let me leave you with an image. Why are people not leaving California? Well, we have mountains, we have ocean, we have endless summer, and we have Pink's signature pastrami hot dogs. So with that, I will stop. Thank you.